Navitas Semiconductor closed its last trading session on June 10, 2026, at exactly $20.50 per share, marking a steep intraday decline of 10.28% as selling pressure accelerated into the closing bell. While that double-digit drop looks alarming on a standard chart, the real story here isn't the sudden correction, but a massive dislocation between short-term retail panic and long-term institutional positioning that happened right under the market's nose. Just days ago, this exact stock surged over 20% following an official confirmation that the company is actively collaborating within the NVIDIA MGX ecosystem to build out next-generation 800-volt DC infrastructure for advanced artificial intelligence hardware. The market ran the price up on the headline, but the moment a broader sector sell-off hit the Philadelphia Semiconductor Index, short-term traders dumped the stock, ignoring the fact that the underlying hardware design wins are locked in for the next hardware cycle. This gap between the headline-chasing narrative and the structural demand for efficient power delivery is where the real opportunity lies. The common belief surrounding small-cap semiconductor plays right now is that they are too volatile to hold during macro downturns, and that giants like the NVIDIA stock or the Apple stock are the only safe havens for hardware exposure. Retail investors looking for investment help often flock to simple online investing platforms, relying heavily on automated tools like Schwab Intelligent Portfolios or generic investing sites to allocate their capital into massive tech tracking funds. The consensus view is that a niche player like Navitas, which lost over 10% of its value in a single day, is a speculative gamble with weak profitability. But looking closer at the physical reality of data center design challenges reveals a completely different picture. The sheer power requirements of advanced AI clusters are hitting a physical wall, and the old silicon-based power regulators simply cannot handle the heat or the energy density required by next-generation graphics processing units. Navitas isn't just trying to sell chips, they are solving the foundational thermal and electrical bottleneck that could stop the expansion of AI infrastructure cold. When you look at daily swings and trading volumes over the past week, the volatility has been intense, with over 30 million shares changing hands in a single session against a historical backdrop that usually sees much lighter volume. This massive spike in volume points to high institutional rotation. Large funds utilizing advanced trading architectures are actively reshuffling their small-cap exposure, and a significant portion of this churn is driven by systematic rebalancing rather than fundamental shifts in the business. Over the last 3 months, public filings show substantial insider selling totaling over $117 million, which understandably spooked retail traders monitoring their accounts on a Robinhood app or checking their individual brokerage balances. However, this selling needs to be framed against the massive multi-100% run the stock experienced over the previous 12 months. Insiders taking chips off the table after a massive macro expansion is standard operational behavior, yet the market treated it as a structural red flag. If you look at the macro picture, high-power markets like grid infrastructure, industrial electrification, and performance computing are seeing a massive capex push. During their last earnings report, Navitas posted a sequential revenue growth of 18%, driven entirely by these high-power sectors. While the company still reports a net loss per share of 15 cents, which causes automated robo-advisors and basic online investment algorithms to flag the stock as high risk, their gross margins are expanding rapidly. This margin expansion proves that their pricing power is solidifying as they pivot away from low-margin consumer electronics like smartphone fast chargers and move deep into the enterprise data center matrix. Large institutional blocks are quietly building stakes through sophisticated vehicles, recognizing that the company's financial strength sits at an impressive 8 out of 10 on core balance sheet metrics, despite the temporary lack of net profitability. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio right now, or if you are avoiding small-cap chip design firms entirely in this environment. To truly understand why the tension between market expectation and reality is so thick here, we have to look at what Navitas actually does. Founded in 2014 and operating out of California, the company specializes in gallium nitride and silicon carbide power semiconductors. Standard silicon has been the bedrock of the computer world for decades, but it operates with high resistance and generates massive heat when handling immense electrical loads. Gallium nitride, or GaN, allows electricity to move through the crystal lattice at vastly higher speeds while losing a fraction of the energy as heat. This allows power supplies to be a fraction of their traditional size while handling exponentially higher wattage. By integrating this tech with their Gen 6 silicon carbide platforms, Navitas has created an architecture that allows direct-cooled thermal management, removing the need for massive heavy copper heat sinks in enterprise servers. Their recently introduced isolated through-hole packaging allows data center engineers to mount power components directly to liquid cooling plates, drastically increasing power density. This brings us back to the classic mistake made by self-investing retail accounts using platforms like Interactive Broker stock trading or browsing through standard Fidelity investments lists. When a casual investor logs into a Fidelity mobile app or checks their Robinhood investments page, they see a company with a high price-to-sales ratio and negative trailing earnings, and they immediately pass. They look at the historical losses and assume the business model is broken. But the reality is that the older business model was tied to consumer phone chargers, an industry characterized by brutal price wars and cyclical retail demand. The new business model is an entirely different machine. Navitas has systematically transformed its executive leadership, bringing in veteran board members from giant legacy chip firms
platforms to steer their strategic pivot into infrastructure. They are no longer competing for a spot inside a phone accessory. They are designing the power delivery boards that sit inside the literal rack architectures powering the cloud. When analyzing the trading architecture through a platform like Interactive Brokers Trading, or checking institutional allocations across Fidelity mutual funds and Fidelity ETFs, you see that small-cap index funds hold a massive chunk of the float. Because Navitas is a prominent component of the Russell 2000 index, anytime macro fears or geopolitical tensions cause a broad market pullback, index tracking funds are forced to mechanically dump shares of NVTS, regardless of its partnership status with tech giants. This programmatic selling creates a massive artificial drag on the share price. The sophisticated investor using an advanced Fidelity trading platform can easily exploit these structural liquidations. When a systematic fund has to unload shares to meet index redemptions, it drives the price down to levels that completely disconnect from the value of the intellectual property and the locked-in design pipelines. Looking forward, the future outlook for Navitas rests on two distinct, highly critical catalysts. The first is the actual production ramp of the 800-volt DC AI infrastructure platforms developed for the server ecosystem. If these designs translate into multi-million-dollar fulfillment contracts over the next 2 quarters, the revenue run rate will scale at a pace that generic Wall Street models have completely failed to price in. The second catalyst is the stabilization of global supply chains for specialized chemical substrates like aluminum nitride, which are vital for their high-voltage isolation packaging. The core risk here is obvious. If enterprise capex spending slows down due to broader macroeconomic cooling, or if corporate data center construction faces regulatory delays, Navitas will have to burn through its hash reserves longer than expected to maintain its research and development edge. Ultimately, the contrast between expectation and reality is what defines this asset. The expectation, visible across standard investing sites and basic SoFi active investing seeds, is that Navitas is an unprofitable, highly volatile small-cap component caught in a downward industry spiral. The reality is that the company has successfully integrated itself into the most critical infrastructure hardware ecosystem on Earth, boasting a robust balance sheet and a massive technological lead in wide bandgap semiconductors. For investors managing their own individual brokerage accounts or utilizing institutional frameworks like Fidelity Wealth Management, the current sector-driven pullback offers a clear view of a structural growth story masked by temporary market noise. The technical volatility will undoubtedly continue, but the underlying physical demand for efficient power delivery suggests that the market's current pessimistic assessment may be radically out of step with the structural reality of the hardware landscape.